Protest in Mexico following the deaths of 5 miners, the disappearance of 10 people, 5 bodies identified and 5 bodies they are working to identify. Now, there was a report on February 10th, about a week ago. Mexico makes arrests after Canadian miners' workers found dead. It's Bloomberg News on February 10th. And here is the update. The Attorney General's office said in a statement that 5 of Vizsla's workers had been found dead after 10 people were abducted from the project, and officials were working to identify another 5 bodies. Mexico's Security Minister Omar Garcia Harfuch said that the miners could have been mistaken for part of a criminal group in Sinaloa state. Quote, in the Army's arrest of the 4 people presumably responsible for the illegal kidnapping, they mentioned that they confused them. According to early statements with members of a rival group, Garcia Harfuch said at a press briefing Tuesday. The 4 suspects are part of the criminal group Los Chapitos, which has an ongoing feud with another group known as Los Mayos, Garcia Harfuch said. Then there was a protest. This is reported on Sunday, February 15th, so 2 days ago. Mexican mining workers march over murder of colleagues. This is Reuters.com, and they have quotes from the slogans. They were not numbers, they were lives. And then a miner, Christian Meza, saying, quote, the objective is to raise our voice for peace and security. And then the chant said, quote, it was extortion, not confusion. Seemingly responding to Mexico's Security Minister Omar Garcia Harfuch's explanation. I mean, it rings true, doesn't it? Who knows what happened there? All we have are words on a screen. But really, I think that's the sense that most people had when you first see the headline of missing miners in Mexico. So it's interesting to see people protesting. They want peace and security. So what that seems to say is perhaps miners in Mexico are starting to be a little bit concerned about the security situation. Perhaps this is not simply protesting a tragedy, but protesting a security situation that enabled this to happen. So, again, a very tragic situation there in Mexico. Now, we have a gigantic story, and hello and welcome to the Northern Miner Podcast. My name's Adrian Pocobelli, here with the world news, at least according to the natural resource angle, which frankly seems to be explaining many things in this world, as it always has, but perhaps today more than any other time that I can remember. Now, there's this story I've been discussing here for weeks, if not a couple of months. Actually, we've been following the uranium in Niger for quite a while. And finally, there is a big story in the Financial Times on this yellow cake, the 1,000 tons of uranium in the crosshairs of ISIS. And the subheadline, Niger wants to sell yellow cake stash seized from France, but it is struggling to find buyers. And we had the attack on the airport just recently, let's call it the last couple of weeks. And the real question with that attack at the airport was the uranium the target? So let's take a closer look at what the Financial Times has to say about this. This is Jacob Judah and Aditi Bandari in London. Sometime since November, a convoy carrying 1,000 tons of uranium rolled out of Niger's remote northern marches, starting a journey to an ultimate destination that remains dangerously unclear. To the military junta that runs Niger, moving the uranium from the mines of Arlit, or perhaps Arli, marked a decisive break with the nation's colonial past. But to France and its state-owned nuclear group Orano, it looked like the possible start of a multi-million-dollar asset grab. Now the uranium offered on international markets but still unsold faces a different threat. It lies stranded at a vulnerable airbase in Niamey that was recently attacked by ISIS militants. The uncertain fate of the uranium sheds light not just on this destitute desert state embattled junta, but also on Paris's rear-guarded efforts to keep control of the uranium from mines it had operated for decades. Niger, whose soldiers are increasingly on the back foot in the battle against ISIS, has started discussions about a sale with countries including Russia, which has a small military contingent in the country. The uranium stash has been estimated to be worth some $240 million. Quote, "We can sell to whoever we want," said Colonel Ousmane Abarchi, Niger's mining minister, adding the country would only sell to buyers it considered responsible. Quote, "We are talking with the Russians, we are talking to the Chinese, we are talking to the Americans," he added. Niger exports a form of uranium known as yellowcake, a processed uranium concentrate used to produce fuel for nuclear power stations. It can also be further enriched for use in weapons programs. Before the military seized power in 2023, it supplied up to a quarter of the natural uranium supplied to power stations in Europe. A quarter. And just on the energy side of things, this situation with France's uranium companies getting kicked out of Niger, I consider, not that far from what happened with Nord Stream and Europe getting cut off on Nord Stream. 25% of the uranium supplied to power stations in Europe is significant, but it hasn't gotten nearly the same amount of press. Some doubt Niger's junta will find a buyer for the stash of uranium it seized. France's Orano, which was in effect expelled from Niger when its assets were nationalized in June, has initiated legal proceedings to prevent any possible sale. Ulf Lessing, a Mali-based expert at the Konrad Adenauer Foundation, said any normal buyer would immediately face a claim from the French. Quote, "You need a rogue state to buy it," he said. Most analysts consider Russia the likeliest candidate. Niger urgently needs to make a sale to replenish its emptying coffers, but a person close to the leadership said it was aware that dealing too closely with Russia could be counterproductive. Quote, "If there was a clear American opportunity, they would jump at it," said one person close to the Nigerians. Quote, "The last thing you want to do is sell to the Russians on the dark market," the person added. Axia Power, a company based in the United Arab Emirates, has shown interest, Abarchi said. Quote, "We are discussing with them," he said, stressing Niger had no preferences. Scrolling down, the deteriorating security situation in Niger has further complicated matters. Attacks by ISIS and JNIM, a local affiliate of al-Qaeda, have multiplied across western Niger and have begun creeping closer to Niamey, the capital. In late January, ISIS launched a surprise assault on Niamey's main international airport and the adjacent military base where the uranium moved from Arli is being stored. ISIS has said the attack, which appeared to target drones located at the base, was planned long before the uranium was moved south from Arli. This is the big billion-dollar question. Did they know that the uranium was there? Did they somehow find out, and was that the target? The assault has humiliated the regime in Niamey, which took power on promises of stabilizing Niger, a country of nearly 30 million people. Quote, "It is probably the beginning of the end," said a Western official. Quote, "It was always assumed Niamey was safe because terrorists wanted it to be safe. This apparently does not stand anymore." It also highlighted the vulnerability of the stranded uranium. Quote, "It is probably not very safely stored, whatever they claim," said Lacine, the Mali-based expert. Quote, "It is not a tenable situation, but nothing suggests they are going to be able to sell it anytime soon," he said. Well, frankly, I don't see why the U.S. doesn't just go in there and buy it if they're willing to sell it to them. And then they can sort out the details with France. I mean, for all of the talk of security out there, this seems to be bubbling quite close to the top. If you have a whole bunch of yellow cake that ISIS is almost purposefully or accidentally seizing. Another headline, this is Bloomberg News, February 14th, Niger ready to return Orano-produced uranium after mine takeover. So a bit of a different spin on the headline. This is Bloomberg News. Niger is ready to return the uranium produced by Orano SA at the Sommer mine to the French nuclear company. 2 months after unidentified attackers who staged an assault on the capital came dangerously close to the stockpile. So Bloomberg is saying that they are ready to give it back to France. Quite interesting. I mean, this is a breaking story, as you can hear. We're getting different accounts from different news organizations. Niger's military authorities took over the mine in 2024, accusing Orano of planning to halt operations and sell its stake without following proper procedures. The government later removed uranium from the site in violation of an arbitration tribunal ruling, raising concerns about radioactive material being transported through jihadist-affected regions. About 95,000 tons of concentrated uranium powder, also known as yellow cake, is ready to be sent back to Orano, military ruler Abdurrahman Tiani said in an interview broadcast on state television RTN on Friday. That's about 63% of the 150,000 tons that was produced at Somaire and mined during Orano's tenure. Before the forced takeover, Orano held a 63% controlling stake of Somaire, with the remaining 37% owned by Niger's state-owned Sopamin. Quote, everything that was produced afterward is Nigerian, and it will remain Nigerian, Tiani said. Orano has operated in Niger for decades and is among the country's largest foreign mining partners. In June 2025, Niger unilaterally nationalized the mine, leaving Orano without operational control. And finally, we have a quote here from the military ruler Tiani. Quote, the original sharing agreement was completely unfavorable to Niger, adding that Niger had requested a review to avoid repeating the mistakes made with uranium. Quote, this caused some misunderstandings, but no partnership runs smoothly forever. We have been working to resolve them. Now, that seems like an insane amount of yellow cake. As a commenter here, I rarely read the comments, but I think the commenter here has a point. Robert Brzdowski, 95,000 metric tons is over 200 million pounds of yellow cake. 150,000 metric tons is over 330 million pounds of yellow cake. Are you sure you don't mean 95,000 pounds and 150,000 pounds? Recent annual worldwide production of yellow cake has averaged about 65,000 tons, fulfilling about 70% of world demand. And that kind of rings true when you think of 150,000 metric tons. That sounds like an insane amount of yellow cake, so Robert Brzdowski may have a point there. But nevertheless, whatever the case might be, this is quite the situation here. Because potentially, should the junta in Niger return the yellow cake that is, supposedly legally belonging to France, that's 64%. Theoretically, legally, a military junta in the Sahel has 37% that they potentially legally own. So it's a little frightening here, what is going on, and it's a relief from over here to see this get more attention. As I've said in previous episodes, let's not forget the clinching justification for going into Iraq was yellow cake uranium out of Niger. Let us not forget. So, again, a bit of a relief to see this get some attention here. As I say, the most exciting beat in the global news narrative here, the natural resource beat, perhaps one of the most concerning as well, as we've heard in our opening stories. Continuing on, another headline, Amazon-backed nuclear company gets U.S. approval for reactor fuel. This is Bloomberg News via mining.com. X-Energy Reactor, an advanced nuclear company backed by Amazon.com, received federal approval to make uranium fuel for advanced reactors, the first such new license in more than 50 years. The company's TRISO X unit is already building its first plant and expects to begin fabricating fuel in 2028. The Nuclear Regulatory Commission license issued Friday authorizes the company to build 2 production facilities at the site in Oak Ridge, Tennessee. So tech continuing to make inroads here into the natural resource sector and continuing in the continent of Africa. Congo says it would seek other partners if U.S. minerals framework fails. And this is Reuters via mining.com. On February 11th, the Democratic Republic of Congo will look for other partners if its mineral cooperation framework with the U.S. does not lead to concrete projects, the country's mines minister said. Quote, everything we have done with America is a framework under which we will discuss questions of mutual interest. That is all it is, Louise Watum Kambamba said on the sidelines of the Indaba Mining Conference in Cape Town. Quote, it may be a good major project. It may also become another project that does not interest them. We will continue because there are many other partners to discuss with. Scrolling down, the minister added, quote, for those who think we are going to sell everything for nothing to America, I must be very clear. We have sold nothing, and we will sell nothing for nothing. He added. Watum Kambamba said Congo's mineral endowment is exploited at less than 10% today. Quote, the rivalry between China and the United States, we are not interested in it. We must play our own game as the DRC. We have our own problems, we must feed people, we must invest in human capital for our youth. So it continues to be interesting in Congo, and we have a few related headlines. Trump aides urge sale of Congo lithium claim to a U.S. company. It's Bloomberg News via mining.com. During a meeting at the White House last month, Trump administration officials urged an Australian mining executive to sell his firm's interest in a major African lithium project to a U.S. company. An unusual session that offers a rare behind-the-scenes glimpse into the administration's deal brokering as it pursues an ambitious, controversial policy on critical minerals. Quote, the White House encouraged AVZ to do a commercially responsible deal with an American company, but did not nominate a specific company, Nigel Ferguson, AVZ's managing director, said in a statement responding to questions from Bloomberg News. Quote, they are not putting pressure on AVZ to do a deal with a specific company, but with any vetted, genuinely American company. The only U.S. firm that's known to have an interest in taking over AVZ's claim to the Monono lithium project is Cobalt Metals, a Berkeley, California-based AI-driven exploration startup whose backers include billionaires Bill Gates, Jeff Bezos, and Marc Andreessen. Cobalt, which has support of the Congolese government, has offered to acquire AVZ's interest at a price that AVZ executives consider far less than reasonable. According to people familiar with the offer, Cobalt declined to comment. The firm's interest in Monono was first reported by Bloomberg last month. So just a hotbed of activity in Congo, and here's another headline. Zijin to launch Congo's first lithium output in June from disputed Monono deposit. This is Reuters via mining.com, so the same deposit. China's Zijin Mining will initiate Congo's first lithium output in June from the disputed Monono deposit and move immediately to exports, the company and state miner Cominiere said, marking a major step in Beijing's push to secure more critical minerals in Africa. Zijin had previously indicated a first quarter 2026 start, but told Reuters on Tuesday that June now reflects updated planning. The Monono resource, one of the world's largest undeveloped hard rock lithium deposits, is at the center of arbitration after the Democratic Republic of Congo canceled Australian miner AVZ's permit. It reassigned part of the site to Monono Lithium, Zijin's joint venture with Cominiere. Zijin holds 61%, with Cominiere and the Congolese state owning the remainder. So, more drama, and another very interesting headline out of the Financial Times, also featuring Cobalt Metals. Belgium Museum caught in row over trove of Democratic Republic of Congo mineral records. This is super interesting, which is the data from the records in the museum. This is Camilla Hodgson at the Financial Times. Millions of records spanning Belgium's brutal rule in what is now the Democratic Republic of Congo are at the center of a dispute over who should control data about Africa's largest copper producer. The documents, housed at a Brussels museum built to celebrate Belgium's empire, are being sought by the Democratic Republic of Congo and Cobalt Metals, a Bill Gates-backed mining and artificial intelligence company that struck a deal last year with Kinshasa to digitize them. So we're entering the land of science fiction here in the mining industry. What a fascinating beat this is. It always was, but now it's really getting next level. In 2026, Cobalt says it has yet to gain access to the papers, which include geological records, but the museum plans to carry out the digitization itself, and Belgian officials say they cannot grant exclusive access to an overseas private entity, despite its agreement with the Congolese government. A Belgian government spokesman said exchanges between the two countries were sustained and ongoing. The records were, quote, federal public archives, and Belgium, quote, cannot give privileged or exclusive access to a foreign private company with which it has no contractual relationship. Well, it's kind of a relief that, not only do us regular citizens face bureaucratic stumbling blocks, even the most powerful people in the world can be slowed down, so to speak, by museum and government policy. And just a few final headlines here. This is also the Financial Times. Will Washington's $12 billion Project Vault launch a minerals hoarding race? An issue I've brought up here the last few weeks. What happens when all of these governments start stockpiling? What is going to happen to the price? This is by Camilla Hodgson in London. Washington's $12 billion minerals stockpiling plan is drawing questions from analysts and traders seeking to understand how the mammoth effort will work and whether it will dislocate global markets. Under Project Vault, unveiled last week, The U.S. will buy and store emergency supplies of a range of critical minerals for manufacturers such as car makers to use in times of crisis. The country's Export-Import Bank will stump up $10 billion in loans to help finance the procurement of metals, including rare earth elements and gallium, that 3 trading companies will purchase. Scrolling down, but details of how Vault will work remain limited, with traders and analysts pointing out the effort is likely to put the U.S. in competition with the other Western nations, racing to reduce their dependence on China for critical minerals. Quote, at the end of the day, the rest of the world will be in competition with the Americans now for that material, said Jan Gies, a metals trader at Frankfurt-based Tradium. Quote, you have a player in the market now with almost endlessly deep pockets, looking to buy up material in metals markets that are tight as it is. That would, quote, certainly, end quote, have an impact on the prices of the metals, especially in the small markets for the niche minerals, he said, quote, it will put pressure on them. Scrolling down, but stockpiling runs counter to a multilateral approach, said Patrick Schroeder, an expert in sustainability and resource governance at think tank Chatham House. Such efforts constitute, quote, an emergency solution, but not a long-term strategy to create a functioning international framework for critical minerals. Once the U.S. starts doing it, other countries will also ramp up their stockpiling, he added. Indeed, Albéric Montgrenier, executive director of the European Initiative for Energy Security, said the European Commission, quote, should develop a similar model as it works to build its own stockpile, noting that Europe is increasingly running behind the U.S., end quote. Finally, a quote from Chris Welch of price reporting agency Argus Media, quote, the market is waiting for answers on volumes, metals, and timelines before it can price anything in. And finally, George Griffiths, head of dealing at AMT Futures, said one major question centered around the fact that storing metals for any period of time costs money. There are financing and storage fees. Quote, it's not clear for me who is supposed to pay that charge, and whether the burden was with the public sector or passed on to manufacturers that wish to draw from the vault stores. So, a lot of moving parts here. So, an exciting show ahead of us. We have Alon Olsha, senior analyst for metals and mining at Bloomberg Intelligence. We discuss the failed merger between Rio Tinto and Glencore to make the largest mining company in the world. We discuss the history of how that deal came about and reasons for why it may have failed. So it's a great opportunity to cross-examine my own opinions. And of course, Alon has followed very closely these companies for years now. So a lot of insights were brought on the table here. So a wonderful interview coming up this episode with Alon Olsha, senior analyst for metals and mining at Bloomberg Intelligence. Also coming up, we have Ricky Chan and Gary Baschuk, co-heads of mining at Pear Tree Canada, and they discuss the upcoming PDAC conference, how financings are going, flow-through shares, and more on this week's Spotlight. So a fascinating discussion there. If you want to find us online, you can find us at northernminer.com. You can find us on X at Northern Miner. You can find us on Instagram at The Northern Miner and on Facebook, LinkedIn, and YouTube, where we also host these podcasts and wherever podcasts are available, including Spotify, SoundCloud, and Apple Podcasts. And with that, let's turn to Gary Baschuk and Ricky Chan of Pear Tree Canada for this week's Spotlight. Join us today. I'm very pleased to welcome to the Northern Miner podcast for this week's Spotlight, Ricky Chan, co-head mining at Pear Tree Canada, and Gary Baschuk, co-head mining at Pear Tree Canada and senior geologist. Gentlemen, welcome to the show.
Thank you, Adrian.
So much going on in the mining business, and Pear Tree, of course, an established name in Canada and globally, is a known entity in the business. Gary, starting with you, Pear Tree has become one of the most active flow-through financiers in Canada. How has your approach to flow-through evolved? And what differentiates Pear Tree Securities from the competition with so much going on out there in 2026?
It's a great question, Adrian. I think Pear Tree's biggest advantages were very adaptive to tax changes. When the flow-through first started off in the 70s, in 2007, it changed to allow gifting in kind to the charities. Ron Birnbaum, our founder, set up the charity flow-through financings. It's a combination of two tax laws, being the flow-through taxes and the charitable giving. And they adapted to that. Then in about 2012, the tax laws changed again. Pear Tree adapted to it. And then when the federal government stopped the CDE for oil and gas, Pear Tree moved forward again And with the critical metals more recently, Pear Tree adapted to that and has brought in a lot more business with that. Also, through the years, Pear Tree has gone from typically about 150 million now to over 550 million dollars worth of charity flow through financing. So we've grown substantially. And we used to be a Quebec-centric organization, and now it's global, where we're working with companies that may be ASX listed, TSX, LSE, etc. So we've expanded it quite a bit. In addition, Pear Tree is, a one-stop shop. We have salespeople or business development people all across the country. They work with the charities and with the donors, have strong relationships with them. In addition, we have a full group of tax experts in-house, a full legal team in-house, and a settlement team in-house. We're about 45 people, and we take care of the clients from the beginning to the end, whether it be the issuer or the donor.
I had Ron Birnbaum on the show maybe 6 months ago, and he had a lot of concerns around, say, recent legislation. Ricky, where are we at in terms of flow-through share financing and the government? Like, is Pear Tree in a happy place right now, or are there still frictions that Pear Tree is trying to, tell the government to address?
We are in an environment where there are a lot of changes. If you look at the past 2 years, first of all, we have the federal budget. There's this proposal that's going to change the capital gain inclusion rate, and that's going to impact a lot on donation. Towards the end, that didn't happen, but there's a lot of things to manage in the background. There's a change to alternative minimum tax. In short form, we call that AMT. That will limit how much a donor can donate as well for a given level of taxable income. So we continuously have to manage a lot of changes. As Gary had mentioned, the benefit for Pear Tree is we have 5 in-house lawyers within our team over here. That helps us to solve a lot of issues when there are new tax legislations that comes in. I'll give you an example. Last year, Quebec made a budget change, and as a result, there is quite a significant change on how much Quebec donors can deduct on these flow-through shares. The tricky thing is that the budget was announced and is effective midnight or so the very next day, while we had 2 live financings, and we were going to close that within 2 weeks or so. So what we can do, what Pear Tree, how we're different from the rest is, well, we do have very good connections with a government relationship consultant as well as with government officials. We were able to arrange a lot of dialogue with the Quebec government to get more clarity, because that piece of legislation, frankly, leave a lot of question marks on what we can do and cannot do still. And we will come up with a solution towards the end to make sure that our donors are happy. So just to answer your question with an example, it's forever changing. Even earlier in the year, the government had proposed to increase the scope of flow through to other industries. It didn't happen. They were proposing to expand the scope of flow through to other applications in mining, including engineering study. Unfortunately, they voted it down. We didn't see that in the latest federal budget. In our industry, every year there's a federal budget, there will be multiple provincial budgets, and we just need to deal with that accordingly.
Okay, excellent. Now, heading into PDAC, of course, we have one of the world's biggest mining conferences, definitely the biggest in Canada. What are you hearing from investors and issuers this year? Gary, I'll pass it back to you. What are you hearing about PDAC this year from clients, issuers, investors?
I think if the Roundup conference held by the AME-BC is any indication, I believe they were about 13,000 people. We can expect probably over 30,000 this year at PDAC. So it may very well be a record year with the high metal prices, copper, gold, silver. The market is bullish. We're seeing huge revenues from those companies, from those producers. Although costs are rising, the revenues are still good and profits will be very good. So it's another very good year. And we expect that to continue with world turmoil and people selling their US dollars, looking for alternative places to place that. They're going into the precious metals. Plus, of course, with electrification, we can see more and more copper use in the longer term. And there are limited supply of that.
Indeed, it's a fun time in the sector. And if you can't be profitable now, it makes one wonder when one can be profitable. Ricky, do you have anything to add on PDAC? What's your sense? What are you hearing?
If we just look at numbers over here, let's look at gold price. I remember that last year we had a very good run, and we concluded the year with around 4,500 in gold price. I remember my mother-in-law came back to me and asked me, what do you think? Should I buy? Should I sell? And little did we know that from 4,500 in the beginning of the year, it turned into almost, over 5,500 towards January 29th, if I remember correctly. Of course, it get corrected, but the euphoria is still there. I expect PDAC to be very, very busy. And if you want to bet on it, that will be a record attendance for PDAC.
Indeed. That seems like a good bet, doesn't it? As long as you're not telling mom to short the market, I think we're in good shape. Okay, excellent. And Ricky, speaking of gold prices, they have remained resilient with all the uncertainty. Are you seeing this help the financing of gold-focused issuers and gold companies? What are you seeing in that regard?
Deal flows are very, very active. This is actually a level of activity we have never seen before. To give you a perspective, last October, we closed off in a month $180 million worth of deal flows. And to give you a perspective on that, we concluded over 570 million for the whole year last year. So 180 in a month is a lot. So fast forward to 2026, this year, we are in 5th or 6th week of the year, and we're expecting to conclude, Gary, correct me if I'm wrong, over 270 million by the end of the month.
Yeah, 280.
So give or take, 50% of the business is done in 2 months of time.
Unbelievable. Gary, do you have anything to add to that, to what you're seeing out there?
I think the other thing we're seeing is a lot of the generalists are now coming into the market or have been coming in since last year. We noticed that we were down in Colorado Springs and in Beaver Creek for a couple of conferences, and there were more generalists taking an interest in the market and more of them present. So we are seeing that, and that's helping to increase the demand.
Okay, excellent. So as we wrap up here, Gary, maybe starting with you, is there any message that Pear Tree has, maybe to the audience, maybe to the government, to investors? Any big picture thoughts as we wrap up?
No, I think the main thing about Pear Tree is that makes us stand out against the others is, we're a full service shop. We take care of the issuers. We stand behind them. We have the tax expertise in-house. We have the legal expertise in-house. We're constantly working with government, working for our issuers and for our donors, and we stand by them. And we're, as I said, a one-stop shop for everything for them.
Excellent. And Ricky, is there going to be a presence at PDAC by Pear Tree? How is Pear Tree getting involved at the conference?
We are a sponsor of the conference for many years now. We believe that it's important to support the industry. So of course, Gary and I will be over there at the conference. So please come by and say hello. And a lot of our fellow colleagues will be over there as well. So if you meet anyone over at Pear Tree, please make sure that you make a point to come by and say hello. And we'll share all of the newest and greatest information with regard to either tax laws or government legislations. We'll make a point to walk around the main exhibition floor as well. So if you're interested to reach out to us, I believe that there will be contact information. Please do reach out, and we'll make sure we arrange a time and have a one-on-one discussion on whatever topic you want to discuss on.
Gary, any final thoughts?
Just looking forward to another busy PDAC and a great year to help out with the industry and the donor side.
Gary Baschuk, co-head mining at Pear Tree Canada and senior geologist, and Ricky Chan, also co-head mining at Pear Tree Canada. Thank you for joining us.
Thank you, Adrian.
Thank you.
Thank you once again to Pear Tree Canada for sponsoring this week's episode of the Northern Miner Podcast. If you want to learn more, visit peartreecanada.com. Turning to the website, the headlines are relentless. Iran says potential energy, mining deals on table in talks with United States. This is Reuters via mining.com on February 15th. Iran is pursuing a nuclear agreement with the United States that delivers economic benefits for both sides, an Iranian diplomat was reported as saying on Sunday, days before a second round of talks between Tehran and Washington. Iran and the U.S. renewed negotiations earlier this month to tackle their decades-long dispute over Tehran's nuclear program and avert a new military confrontation. The U.S. has dispatched a second aircraft carrier to the region and is preparing for the possibility of a sustained military campaign if the talks do not succeed, U.S. officials have told Reuters. U.S. Secretary of State Marco Rubio, speaking at a news conference in Bratislava, said President Donald Trump has made it clear that he would prefer diplomacy in a negotiated settlement, while making clear that that may not happen. Quote, "No one's ever been able to do a successful deal with Iran, but we're going to try," Rubio said. And we have a quote from Iran's Foreign Ministry Deputy Director for Economic Diplomacy, Hamid Ganbari, who said, quote, "For the sake of an agreement's durability, it is essential that the U.S. also benefits in areas with high and quick economic returns." Common interests in the oil and gas fields, joint fields, mining investments, and even aircraft purchases are included in the negotiations, Kanbari said, arguing that the 2015 nuclear pact with world powers had not secured U.S. economic interests. So natural resources at the heart of negotiations there. With Iran continuing on, Trump trade team working to narrow scope of metals tariffs. It's Bloomberg News via mining.com. I always wondered about these tariffs that the U.S. was putting on metal coming in and how that was going to impact the U.S. economy. Let us see what it says here. This is Bloomberg News via mining.com. The Trump administration is working to narrow its broad tariffs on steel and aluminum products that companies find difficult to calculate, and the European Union wants reined in as part of its pending trade deal with the U.S., a person familiar with the matter said. The Office of the U.S. Trade Representative is scrambling to resolve complications spawned last year by the Commerce Department's effort to rush out President Donald Trump's tariff agenda, the person said. The White House has communicated to companies that adjustments are in the works, but details and timing remain unclear, the person said. The rollback plans were reported earlier by the Financial Times. Aluminum and other metals fell following the report, while shares of U.S. steelmakers and aluminum producers sank. A White House official speaking on condition of anonymity said any reporting about changes to the current U.S. tariff regime is baseless speculation unless announced by the administration. Trump will never compromise on reinvigorating domestic manufacturing of steel, aluminum, and other key products, the official said. In another U.S. headline, Trump orders Pentagon to buy coal power and boost to industry. And that is Bloomberg News via mining.com. Continuing into iron ore. This issue between BHP and China, we have Mike Henry, CEO of BHP, weighing in, and here is the headline, BHP CEO confident China iron ore talks will be resolved. And this is Reuters via mining.com, and this has been going on for months. I believe it's September, believe it or not. Here's the story. BHP Group CEO Mike Henry said on Tuesday he was confident that issues with Chinese customers over new iron ore contracts would be resolved, although talks would take some time. Quote, the overall relationship for me, it's on track. But that doesn't mean that from time to time you don't have tougher commercial negotiations, and that's where we find ourselves, Henry said on a call after the miner reported half-year results. The world's largest listed miner earlier on Tuesday posted a stronger-than-expected half-year underlying profit driven by copper, which for the first time surpassed iron ore to account for more than half of its earnings. So really not too much information there from Mike Henry on what's going on there. Continuing on the iron ore front, contract worker dies at Rio Tinto's Simandou mine in Guinea. This is Reuters via mining.com. A contract worker died following an incident at Rio Tinto's Simfer mine, part of Guinea's Simandou iron ore project, the world's largest producer of iron ore, said on Sunday without providing further details. The death is the latest in a series of fatal accidents linked to the construction of the mines, port, and 670-kilometer railway connecting the remote mining region to the Ghanaian coast. Operations at the Simfer mine site were suspended following Saturday's accident, the Anglo-Australian miner said, while its chief executive Simon Trott said he would travel to Guinea this week. Quote, we are determined to learn from this incident and to do everything we can to provide the safest possible workplace and prevent tragedies like this from happening, Trott said in a statement. A Reuters review of internal documents in March found that at least 13 local workers had died between November 2023 and late 2024 during construction work of the infrastructure, including one death reported by Rio Tinto. The company has confirmed 2 more deaths since, including that on Saturday. In October, co-developer Winning Consortium Simandou said 3 foreign workers were killed in a separate site accident. That takes the death toll to at least 18 workers since construction of the railway and mines started. Seems like a pretty high number. More on iron ore. Liberia sees iron ore output tripling on ArcelorMittal expansion. This is Reuters via mining.com. Liberia expects iron ore output to triple to around 30 million metric tons this year, driven by ArcelorMittal Liberia's planned ramp-up and fresh volumes from new and revived projects, the country's mines minister has told Reuters. And continuing on, just a headline here, BHP profit beats forecasts as copper tops iron ore earnings on AI-driven demand. That's Reuters via mining.com. And another headline, BHP's Vicuña unveils $18 billion copper investment in Argentina. This is Reuters via mining.com. Buenos Aires miner Vicuña Corp controlled by BHP and Lundin Mining, announced on Monday an $18 billion multi-year investment plan to develop copper, gold, and silver mining projects in northern Argentina. So Alon and I discuss Argentina a little bit in our upcoming discussion, so you may want to hear that. Continuing on, Mexico and Canada plan joint action on minerals. This is Reuters via mining.com. Mexico and Canada will present a joint action plan on minerals, infrastructure, and supply chains in the second half of the year, Mexico's economy minister Marcelo Ebrard said on Monday after meeting with Canada's Minister of Trade, Dominic LeBlanc, in Mexico City. You really get the impression that Mark Carney is hard at work in his role as Prime Minister. We're seeing a barrage of headlines. It is like Canada is going on offense, and I think he even characterized it as such, interestingly. So we're seeing more evidence of that. Quote, "We are preparing during the next month the action plan between Mexico and Canada in order to expand investment, increase commerce, reduce regulatory difficulties or obstacles, and facilitate investment," Ebrard told journalists. He also said a delegation of Mexico's finance ministry will visit Canada to continue conversations without providing a date. So very interesting there. Another headline, France to invest 50 million euros for stake in Imerys lithium project, and that's Reuters via mining.com. Continuing on, CME looks into launching first ever rare earth futures contract. This is Reuters via mining.com. CME Group is working on a plan to launch the world's first futures contract in rare earths, three sources with knowledge of the matter told Reuters, in a move that would allow governments, companies, and banks to hedge exposure to a sector controlled by China. Rival Intercontinental Exchange is also looking at rare earth futures, but is not as advanced in its planning as the CME, two of the sources said. CME declined to comment, and ICE did not immediately respond to a request for comment. Scrolling down, CME, the world's largest derivatives marketplace, is working on a new futures contract combining the two most important rare earths, neodymium and praseodymium, said the sources, who declined to be named because the information has not been released publicly. Quote, "It's such a key missing piece of the puzzle for the industry right now," end quote, one of the sources said. No final decision has been taken regarding any launch. One challenge is that rare earths are thinly traded and the market is tiny compared to those for most other metals futures. Indeed, that has always been the issue. So I'm not sure how they're going to solve that. I'm sure there's a mathematical formula, though, that they can employ to account for the risk and the lack of volume. And another headline, aluminum price rises as looming smelter closure adds to supply strains. And this is Bloomberg News via mining.com. Aluminum led most industrial metals higher as the looming closure of a smelter in Mozambique underscored the growing constraints on supplies in key consumer markets. I mean, the irony is huge. With all of the concerns around metal supply, it's like an ongoing dripping of headlines of how these smelters are closing. So this is a smelter in Mozambique, and more concerns around supply. This time it's nickel. Madagascan miner Ambitovi's operations hit by cyclone. This is Reuters via mining.com. The cyclone that hit Madagascar this week has halted production at cobalt and nickel miner Ambitovi, traders said, adding that a prolonged outage could lift prices of the battery material. And this is Reuters via mining.com. And so, as I like to call it here, the real-world business of mining. And another headline, nickel price jumps as Indonesia's top mine cuts output. It's by a staff writer at mining.com. Nickel prices rose for a fourth straight day Wednesday after Indonesia ordered the world's largest nickel mine to sharply cut output in a move aimed at tightening global supply and lifting prices. So more pressure on the nickel market. And finally, BNP backs gold price to hit $6,000 as rally, quote, makes sense. And that is Bloomberg News via mining.com, and they are saying gold may climb to $6,000 an ounce by the end of the year, and bullion's ratio to silver is set to rise as macroeconomic and geopolitical risks persist, BNP Paribas SA's David Wilson said. So it is a torrent of headlines here on a regular basis. Those are your news stories. Now, let's take a look at metal prices. And turning to metal prices, let's take a quick look at the bond market for context. The U.S. 10-year bond is yielding 4.03%. That is down 0.15% on the week and almost at 4%. Incredibly. So quite a drop in the last month. 4 weeks ago, we were at 4.29%. The UK 10-year gilt is yielding 4.37%. That is down 0.13% on the week. The Italy 10-year bond is yielding 3.36%. That is down 0.08% on the week. France's 10-year bond is yielding 3.32%. That is down 0.11% on the week. And Germany's 10-year Bund is yielding 2.74%. That is down 0.09% on the week. And we are starting to see what looks like a narrowing of spreads here between Germany's 10-year bond and Italy and France's 10-year bonds. Interestingly, Japan's 10-year bond is yielding 2.13%. That is down 0.1% on the week. And China's 10-year bond, steady as she goes at 1.81%, and that is 0.01% higher. So there are increasing concerns around the strength of the global economy. Of course, AI concerns and taking everybody's job is supposedly starting to hit the market, so one wonders if we are seeing a bit of a risk-off trade into bonds. Turning to precious metals, gold is trading at $4,941 even, and that is $138 lower than last week and back below $5,000 an ounce. Silver is trading at $74.50 per ounce. That is $7 lower than last week. Platinum is trading at $2,050.30 per ounce. That is $67 lower than last week. And palladium is trading at $1,771 even. That is $28 higher than last week. So gold, silver, and platinum falling, palladium rising. Precious metals continuing to show volatility. Turning to industrial metals, copper is trading at $5.77 per pound. That is 18 cents lower than last week. Iron ore is back below $100 per metric ton at $99.66 per metric ton. That is 45 cents lower than last week. Aluminum is trading at $1.38 per pound. That is 4 cents lower than last week. Lead is slightly lower at 89 cents per pound. That is a penny lower than last week. Nickel is trading at $7.78 per pound. That is 17 cents lower than last week. Tin is slightly lower at $21.18 per pound. That is a penny lower than last week. Cobalt is unchanged at $25.53 per pound. Lithium is back above $20 at $20.82 per kilogram. That is $1.25 higher than last week. And uranium is also higher at $89.50 per pound. That is $4 higher on the week. And zinc is trading at $1.49 per pound. That is 5 cents lower than last week. So once again, it seems as though industrial metals as a whole are showing concern potentially around the global economy, with some exceptions in individual markets based on supply and demand, such as lithium and uranium. And those are your metal prices. Coming up, I'm very pleased to welcome back to the Northern Miner Podcast, Alon Olsha, Senior Analyst for Metals and Mining at Bloomberg Intelligence. And we discuss the attempted merger by Glencore and Rio Tinto and reasons for why it didn't go through, and really just how complex that deal really is. So a fascinating discussion with Alon Olsha. I hope you enjoy it, and I will see you on the other side. Join us today. I'm very pleased to welcome back to the Northern Miner Podcast, Alon Olsha, Senior Analyst for Metals and Mining at Bloomberg Intelligence. Alon, welcome back.
Thanks, Adrian. Great to be here.
It's great to have you again, Alon. I got some very positive feedback on our last discussion. And of course, you are quite focused on Glencore over there at Bloomberg. And there has been this gigantic story that happened that potentially was going to make the biggest miner in the world, $260 billion merger between Glencore and Rio Tinto. So how are you doing? I guess it's been a busy start to the year for you.
Yeah, it's been an incredibly busy start, but I'm not complaining. It's good when the sector's back in vogue. And yeah, it was a bit of a surprise that the deal came so quickly. It's something that investors, the market's been discussing for some time. The companies have attempted this combination before, but never as seriously as on this occasion. They were, of course, it seems, outed by the Financial Times here in London, which put a clock on the talks. Although, they were able to request and would likely have received an extension to the deadline to submit an offer, which they elected not to do. It appeared, if you read what was written in the press, that it all fell apart on valuation grounds.
Right. And I want to get to that, the reasoning behind why it didn't happen, at least so far. Before we do, though, I'm just curious. I mean, this has been discussed for over 10 years, this idea that Glencore and Rio Tinto could merge at some point. Why have they both been seen as a good match for each other? Why have they been in discussion for so long? Like, what is the attraction here?
Well, I think, look, the sector as a whole, especially the large diversified miners, they're turning towards M&A, particularly now, really for two reasons, I would say. Really two kind of structural forces that are driving this big push towards acquisitive growth. Firstly, it's portfolio concentration. So diversification as a strategy appears to have lost appeal. And that's been the case for some time now amongst the big miners. And that's because commodity outlooks across the complex, they're diverging quite sharply. Boards increasingly, want exposure to metals with, the strongest long-term fundamentals, and copper sits at the top of that list. Organic growth helps, and the miners, certainly in the last 2 to 3 years, have been pursuing organic growth, but it is slow, it's capital intensive, it's politically complex, it has all sorts of execution risk, and there's now this kind of clear sense of urgency to secure these copper heavy pipelines before assets are fully de-risked and then re-rated and effectively priced beyond reach. So I think that's one of the reasons I think that's motivated Rio to potentially consider this as seriously as it did this time, where I think in previous occasions it was more of a push from Glencore management, pushing on the door to check it was open. It creaked open, but not all the way. Whereas on this occasion, it seemed Rio was willing to have the conversation. I think there's also a broader theme emerging here, which is one of scale and relevance. And in some senses, it's pursuing scale almost for its own sake. And that's because the sector's been grappling with this loss of relevance for some time now, despite supplying the raw materials that underpin electrification, AI, defense, all these shiny new themes. The miners seem to have been eclipsed by a lot of other industries. Obviously, tech is the big one in terms of market cap, in terms of index weights, in terms of investor attention. And the shrinking presence they have now in major equity benchmarks, it's dampened a lot of passive investor flows into the sector. It's reinforced valuation discounts. And we ran some numbers a few weeks ago to kind of put that all into perspective. In 2010, if you looked at the combined market cap of the five largest companies in mining, financials, healthcare, and tech, each roughly represented about 3% of the MSCI World Index, plus or minus 0.5%. Fast forward 15 years later to 2025, financials and healthcare have edged slightly higher in terms of their index weights. And that's even as tech has expanded its weight nearly tenfold, whereas for the big mining companies, it's fallen to less than 0.5%. So that's a profound shift in capital allocation and visibility. And it's something that's vexed management teams of these big mining companies for some time. So proponents are arguing that consolidation and the greater scale, it can really restore index relevance, deepen liquidity, lower cost of capital, all of which is true to an extent. But we know that the sector doesn't have a great track record of undertaking M&A, particularly large-scale M&A. So there is a cautionary note in there. And I think we're at that point in the cycle, particularly when the environment and the mood seems so febrile in terms of M&A. Everyone seems to be wanting to buy everyone else. You're hoping that there are some guardrails that are put up at some point or that are up already to ensure that they do still deploy capital or their stock in acquisitions in a judicious way.
This is super interesting in the sense that I was speculating last week, is this bigger for the sake of being bigger? Is this just people trying to, increase their prestige, shall we say, and we're going to be the biggest miner rather than Rio Tinto falling to number 3. Glencore is just doing okay, but nothing too special with their share price. But you're saying, if I understand you right, it very well may be a bigger for the sake of being bigger, but this is a stock market story. It's not necessarily about individual personalities that need to be at the top of the food chain, so to speak. Do I understand you right?
I think that's certainly one of the elements. I don't think the motivation here for Rio themselves is to catapult themselves, beyond their big rival BHP in Australia and become the world's largest mining company by some margin. It's about recrafting the narrative for metals and mining, being part of that larger conversation. We produce the materials, we extract the commodities necessary to build the modern economy. The stuff we produce is the backbone of all these emerging themes: AI, defense, electrification, and they're trying to recraft that narrative. So that's one of the elements. For Rio in particular, the challenge they have is by far most of their commodity exposure, most of their earnings is still driven by iron ore. And they have a phenomenal business. It's a great business, generates very strong cash flow through the cycle and will continue to do so. But iron ore is firmly now kind of a late cycle play. Chinese industrialization, it's not over, but it's slowing. The economy there is transitioning. So that kind of very metals intensive phase of their growth is largely done, whereas other commodities, and copper in particular, has exposure to these other kind of emerging themes, which China is also pursuing, but it's not just a China story, it's a global story. So they're in a position where they need to pivot their portfolio away. They want to pivot towards commodities that they think have good fundamentals. They did a counter-cyclical acquisition in lithium, where they bought Arcadium a couple of years ago. In copper, they've done a great job in expanding their own pipeline and bringing new tons to market. But when your base is such a massive iron ore business, it's tough to move the needle. And so, particularly when you look post-2030, they don't have a lot of growth in the pipeline. So I think they're trying to solve for that by potentially doing an acquisition now. Maybe that was the motivation. One of the motivations, do a deal now. Glencore, what does Glencore have? Yes, it has an existing copper portfolio, around 850,000 tons of copper. But in December, they put a lot of color and definition around what is on paper a very large copper project pipeline that could significantly increase production, potentially to 1.6 million tons by the mid-2030s. So for Rio, that is potentially quite attractive. And I think from their perspective, they could bring a lot of their very strong project management, project development expertise and track record to those projects in a way that Glencore would possibly struggle to, because they don't have a track record of doing big projects. It's something that they've tried to avoid historically. So I think it's all those factors really that have played, I think, into the decision. But I must say, I never thought it was a very natural combination, those two companies coming together.
Indeed. I mean, as I said last episode, it's the deal that no one asked for to a certain degree. I kept wondering to myself, what is the impetus? Now, it's quite interesting what you say about copper, of course, because in a sense, we could see impetus there. Everything you say actually, seems like not bad grounds. From, say, Rio Tinto's point of view, here's some copper. And I was just reading a headline. I mean, Glencore's copper output was down something like 40% last year. Where is Glencore's copper, actually, briefly?
Yeah, so their current operations are the DRC, so the Congo, and in Chile, and in Peru as well. And that's where their projects are. Plus, they have projects coming on in Argentina. So that's the new frontier for copper growth, not just for Glencore, where they have significant exposure there, but also for BHP. And then Rio itself has a fair amount of exposure already there with lithium. So there is an argument, to digress slightly, that there was a risk of potentially over-indexing themselves to Argentina, which the mood music is great at the moment, but there are risks.
And as you were saying, that Rio Tinto offered an expertise with these very large kind of projects that maybe Glencore didn't necessarily have as much of.
Yes, I think that's absolutely right. I think Glencore is not a company that has historically pursued certainly large greenfield projects. They've always preferred lower risk brownfield expansions, debottlenecking projects, and were always quite keen to optimize capital allocation if the projects weren't, if they were bringing tons into a market that wasn't particularly tight, they often didn't see the value in it and would rather return that cash to shareholders in the form of a special dividend or a buyback. And so they obviously had a lot of expertise in building projects, but never developed the same kind of company-wide culture and necessarily best practice as some of the other more traditional mining companies. I mean, it was only until relatively recently that they appointed kind of a head of projects and are looking to kind of bolster and beef up their projects team, particularly as they look to now develop this very large pipeline of projects.
Okay, excellent. And I want to get to the reasons why it didn't work out in a second. But I just saw, now Glencore post the failed merger has now been divesting, or it sounds like they're selling a large stake in their DRC copper portfolio to Orion, this American conglomerate of sorts. Is that just kind of a nipping and tucking sort of thing and just kind of cleaning up, for lack of a better term, the shop window and making things, just cleaning it up a bit? Why are they getting rid of copper if copper is so hot?
I don't think they would see it as getting rid of copper. It's selling a minority stake for what is a good valuation. And critically, I think copper in the DRC and these assets, whether it's the Rio deal or a potentially another bidder, it does present some concerns. It's in the DRC. Not all companies want to operate or have the appetite to operate there. Glencore's been there for a long time. They've operated relatively successfully, but they haven't been easy assets necessarily to run. The last few years haven't been easy years. And so a deal like this crystallizes value on these assets, whereas the market may have placed an emerging market or developing country discount, probably quite a severe one on these assets. So it solves that issue. Plus, you're effectively getting the buy-in indirectly of the US government into these assets, which mitigates a lot of risk. And of course, this is part of a broader power play happening at the moment between the US and China, where they're both trying to kind of reorder critical mineral supply chains. And they're using leverage where they can to achieve that objective. So it actually looks like it's quite a smart deal for Glencore. And I think it takes that issue off the table for any potential future bid, whether it's Rio or another party. And, given the challenges also Glencore's had with the US in the past, the big Department of Justice fine for bribery, the fact that they've got now, kind of an indirect interest, the US government in these assets, and they will be looking to exploit them and try, increase flow of material, copper and cobalt to the US. It's quite an interesting turn of development.
Interesting. It's like as if there was a lot of political value in what they were doing. And they did de-risk the project, as you say, indirectly, we might say, with the buy-in, so to speak. Okay, so now getting to the kind of meat and potatoes of why this didn't work, there were two basic major lines of reasoning that I saw as far as why the Rio Tinto Glencore merger never went through. Primarily, as you mentioned before, this was an issue of valuation. And it sounded like at the time that the valuations were done, that iron ore was quite high, which worked in Rio Tinto's favor, whereas coal was maybe not doing as well, and that worked against Glencore. And that Glencore felt like the earlier ratio, so to speak, over time didn't seem to make as much sense, particularly as the deal was outed. So that was one issue, a matter of valuation, and they won 60-40, and it was something before it was something, I don't know, 68-32. So that was one issue. And then there was this other issue, which I thought kind of fed into my kind of more that this was about personality, which again, probably unfairly. But this notion that Rio Tinto wanted both as far as I understand, the chair of the board and the CEO roles, which seemed to me, I'm not an expert on M&A, but that seemed to me kind of unusual. And if this was about shareholder valuation, Why are they getting hung up on who's getting which job and this sort of thing? And can't they sort that out if this is all for the best of shareholders? What happened with this deal?
Yeah, so I think those are all very fair observations, and you're right. I think the valuation is the thing that caught most of the headlines. I think that was always going to be the hardest hurdle to overcome, though, far from the only one. We discussed this earlier. The two companies aren't a natural fit. I think that's probably true of any combination between Glencore and a traditional miner. Glencore is trader-led. The marketing arm is effectively the tail that wags the dog. So cultural compatibility would have been a real challenge, in my view. And execution risk was another major obstacle. So, a tie-up would have immediately raised questions about portfolio rationalization. Do Rio shareholders want coal? Do they want zinc? Do they want smelting and other assets that don't sit comfortably in the portfolio? Top of that, there would have been competition scrutiny, integration complexity. The company would have been over-indexed to Argentina. Even if the valuation had been closer, expectations had been closer, Rio still would have taken on significant operational and reputational risk. And they would have done that at a point in the cycle where copper sentiment is really good. It's really buoyant, and asset values are therefore elevated. So it was always going to be a pretty difficult proposition to defend to shareholders. And, I think it's worth remembering, it's just 2 months ago, Rio, at their Capital Markets Day, they emphasized three things: simplicity, productivity, and disciplined capital allocation. A transformational acquisition like this doesn't obviously align with those priorities. So it would have delivered copper exposure and a deep pipeline of development options, but at the cost of materially greater complexity. And clearly, it would have been a distraction for management away from simplicity and productivity. So, in effect, Rio would have been trading portfolio clarity and capital discipline for scale in copper. And given that there was a valuation gap, that was a bridge too far. I think Glencore is arguably the winner here, either way. The discussions were unsuccessful, but I think the whole thing has reinforced the value of its copper portfolio, and it's validated its growth ambitions. I think they'll feel pretty good, and they won't have any difficult questions to answer. I think insofar as the management question is concerned, I share your view. I also think it's quite strange anyway. As the senior party in this transaction, the larger player, the acquirer, your CEO and your chairman will be the CEO and chairman of the combined companies. That's usually how it works. It's usually not something that's up for discussion. So I was surprised it was something that kind of made it into the headlines as an issue. I suspect the reason is, and this is just complete speculation, but in the past, perhaps there were discussions or suggestions that Glencore management would stay in place. I think there's one really interesting point here with Glencore, which doesn't get a lot of attention, which is its marketing arm. Its marketing arm works well. It sits obviously very comfortably within Glencore, under the Glencore umbrella. But to lift that and put that into a traditional mining company like Rio Tinto, with all its risk committees and decisions made, considered decisions made often by consensus, that doesn't naturally fit well together. There is a culture clash there. And I have always wondered how that would work. How do you put a Glencore trading business into a Rio Tinto? And is it sustainable? Is there a risk of talent leakage over time because they don't have the autonomy and the independence to trade in the way they want to trade? And so I wonder perhaps maybe where the issue around management and who controls what perhaps came from that issue.
So in a sense, my surface level read, originally I was like, oh, well, maybe this sounds like a good match to a certain degree. There are companies that, just based on previous news stories, tend to have what I would loosely call, for lack of a better word, kind of a more ruthless, with Glencore and their allegations in Africa of bribery. Rio Tinto blowing up the Aboriginal 40,000-year-old sites seemingly knowingly in 2020, I thought, well, maybe that's actually not a terrible fit, but that sounds oversimplistic based on what you're saying, that, You also have to consider the front lines of this, the pragmatics of this. One's a trading business, or one has a big trading business. How does that fit into something like Rio Tinto? There's something that seems like this could be a massive sprawling entity, so to speak.
Yes, and I think the point I make on trading cuts both ways, because from Rio's perspective and Glencore, they also see that as a massive opportunity. Glencore doesn't trade a huge amount of iron ore. The reason Glencore acquired mining assets, it was traditionally predominantly a trading house. It effectively backward integrated because it saw the benefits of actually owning upstream assets and the opportunity that combining with Rio presents in terms of being able to push a substantial amount of iron ore volumes through its marketing business, I think is something that they find, probably both parties would find, very attractive, particularly at a time when the Chinese government is trying to assert its control over the market as the world's biggest consumer. So I think that's also a factor which, yes, culturally, it's not a natural fit, but at the same time, perhaps there's just an opportunity there that's just too good to pass up, and they would have given it a go.
Yeah, very interesting. In a sense, from Rio's perspective, you're saying having seasoned traders and negotiators when you're having these issues, say with China and trying to get your iron ore exported into the country, maybe that's not a terrible people to have on your side.
Yeah, exactly. And the ability to diversify your customer base, find opportunities in a market which over the medium to long term is certainly softening.
So as we wrap up here, Alon, I want to ask you another big question, which actually I didn't see hardly discussed, if at all. I'm sure someone must have brought it up, but I didn't see it, which is the regulatory side. I mean, one of the big questions I would have, or I had to myself, is, well, it's all fine and good if Glencore and Rio Tinto finally want to have their wedding and decide they're going to do this. But what about the governments of Australia? I assume it's the government of Switzerland. What about them? I mean, in this environment, is Australia, I guess it would be Switzerland, are they ready to let go of Glencore? Or am I overcomplicating this and actually it wouldn't be a big deal? We're all on the same side here, Adrian. What is your sense of the government and regulatory context here?
No, I think it's very relevant. I think it's become increasingly relevant over the last few years. Governments don't want to let go of companies they see as national champions, particularly in the area of critical minerals. Would Switzerland have kicked up a big fuss? I'm not sure. I think more Australia would have been, the Australian government would have been the ones looking for reassurance. And I think that would have been absolutely critical. There would have been some level of reinsurance would have need to have been provided to them, in order for this deal to go ahead. Not too dissimilar to Anglo-American and Teck. I mean, one of the primary reasons that deal is proceeding and got the blessing of the Canadian government is because they're effectively kind of they're bolstering and growing what was already a Canadian mining champion. With Rio, still a huge chunk of their asset base would have been in Australia, a Rio Glencore combination. You would have had all the iron ore there. You would have had, most of Glencore's thermal coal there as well, and other assets. So they would have still had a significant presence, but they would have certainly have had to answer the question around where is the primary listing. There would have certainly been a lot of sensitivity around that issue. And so actually getting this deal done, again, it goes back to my point on execution risk. It would not have been easy. You would have had to have addressed the concerns of governments in multiple jurisdictions. In this case, it's about the listing jurisdiction. In other instances, there would have been competition issues raised by all sorts of parties, particularly the Chinese, where this company would have been a very large, would have been the world's, a global number one player in copper, a metal that the world is trying to get more from. And so I think, again, from a competition perspective, it would have presented risks as well. So there were all sorts of complications to get this deal done.
Final question, just on the ESG side of things. Did you hear anything from the Rio Tinto side, or did you hear any concerns around, say, Glencore's coal? Because it seems Rio Tinto has made an effort to kind of move towards these kind of new energy type metals, as you mentioned, the lithium acquisition. Did you hear anything in that regard as far as just concerns around that?
We've not heard, certainly certain investors would be somewhat concerned about regaining exposure to coal after it had been divested. But the mood around coal and exposure to coal has changed dramatically since Rio Tinto disposed of their assets. They did that when we were at peak ESG. We're now well past peak ESG. The market's attitude has changed. Does that necessarily mean that Rio itself is seeking to regain exposure? Not by choice. I don't think so. But it probably wouldn't have been as difficult to sell that to its investor base as it was maybe a few years ago. Ultimately, though, I think if the two businesses did come together, I would have expected some plan to be put in place, maybe not immediately, but not that far off, to divest of those assets, to potentially spin them off into a US listed coal pure play, much like Glencore was considering doing early last year. So I think it wouldn't have been an outright obstacle to the deal getting done. But again, it was potentially another complicating factor, something that would have needed to have been explained and where the risk would have needed to be mitigated.
Okay, excellent. And final thoughts, Alon. What are you looking for going forward here from Rio Tinto and Glencore?
So I think, the deal didn't happen, but ultimately I think both companies still face the strategic issues that this merger was meant to address. So Rio needs a credible post-2030 growth strategy, particularly in copper, to accelerate their pivot away from iron ore. And Glencore needs to transform all the portfolio optionality it has in copper into disciplined project execution. And so I think that's what we're going to be focusing on going forward. I think Rio will have some interesting questions to answer now that they opened the door here, that they were willing to look at an acquisition as complex as Glencore after they had set out their stall in December, which was one based on simplification, judicious capital allocation. And Glencore will actually need to kind of put its money where its mouth is. It's set out this big stall of great projects, but the market has lost patience with Glencore underperforming on production for the last several years and not investing in its pipeline. Now that they have set out this pipeline, they're expecting it to deliver.
Fascinating. Alon Olsha, Senior Analyst for Metals and Mining at Bloomberg Intelligence. Thank you for joining us and sharing so many of your insights with us today on the Northern Miner podcast.
Thanks, Adrian. Great to be here again.
Thank you once again to Pear Tree Canada for sponsoring this week's episode of the Northern Miner podcast. If you want to learn more, visit peartreecanada.com. And thank you again to Alon Olsha of Bloomberg Intelligence for appearing on this week's episode. And thank you, dear listener, for continuing to support this program. If you want to help out the podcast, please leave us a review in the Apple Podcast directory. Share it with your friends. And until next week, take care.